Hi, I'm Artie and I'm one of the moderators at Bearable Traders community. In this 60+ minute course that we're putting here for free on YouTube, we're gonna cover everything there is to know to get you started with option trading. In it, we'll cover things like buying calls versus selling calls, buying puts versus selling puts. We'll give you some definition, some trading example, how to set up strategies such as covered call as well as vertical spreads, and we'll go into a lot of details when it comes to implied volatility, which is really the toughest thing when it comes to option trading. So this is about 6 or 7 years of experience summarized into 1 hour, and we put it here on YouTube for free, so hopefully you'll enjoy it. Thank you. Hi, welcome to Option Trading for Beginners. My name is Artie Ziznia. I'm the author of Stock Market Explained, a beginner's guide to investing and trading. In this course, we're going to talk about really the basic of option trading. What is a call? What is put? What's the difference between buying a call or selling a call? What is the difference between buying a put or selling a put? We're going to discuss some key strategies like vertical spreads, covered calls, cash secured puts. We're going to spend a lot of time on the Greeks and the implied volatility. If you're new to the options and a little bit overwhelmed on all the material that is out there, this class is a great foundation for you to start your journey. After every small video class, there is a quiz where you can test your knowledge, and only after you've passed those quizzes, you can move on to the next class. In this video series, you're going to learn everything there is to know about option trading. And after that, if you want to move on and even complicate things a little more, you can go to our advanced option trading class. I hope you choose this course and I hope you enjoy this course. I put a lot of time and effort into this, and I hope you can make a lot of money in the stock market. Thank you. Welcome to Option Trading for Beginners. I want to congratulate you for taking this course. This course is a great stepping stone for starting your option trading journey. So let's discuss on what you can expect out of this course. Well, first we're going to talk about why options. Why options? Then we're going to talk about the payout and profit and loss potential. So we'll talk and discuss about why options are such powerful tools that you can use on your everyday trading, even if you're using a long-term investment, how you can utilize them. We're going to talk about option Greeks, open interest, and volume. We're going to talk about implied volatility. Implied volatility is one of the most important aspects of option trading, and in this course you can get a really good grasp of what implied volatility is and how you can use implied volatility in your option trading. We're going to cover some basic strategies. We're going to talk about calls, puts, cash secured puts, covered calls, and protective puts. So these are the basic foundation of every option trader. You have to understand what is the difference between a call and what is the difference between a put. What does it mean to sell puts and what does it mean to sell calls? These are the foundations of a successful option traders. And lastly, we're going to talk about verticals, credit and debit verticals. These are the base for every advanced strategy. So if you understand how to use verticals correctly, you can take on the next course, which is the advanced option trading. So without further ado, let's get started. So let's discuss by answering the first question, a very important question. Why options? You probably have some background trading stocks. You go long the stocks when you're betting on the stock appreciating in value, and you go short stock when you're betting that the stock is going to fall in value. But what about the time where stocks are not doing much? They're consolidating. Well, that's exactly one of the reasons you have to add options to your arsenal and to your toolbox. So options could be along throughout the whole lifetime of a stock. So let's take this imaginary stock that IPO'd at $30. You had that classic IPO pop, the stock went up, some sell off, some insiders taking profit. You have that accumulation phase, you have the market up phase, you have the distribution phase, and then you have the market down phase. For every stage of stock life, there is an option strategy. You have short straddles, butterfly strategy, condor strategy, risk reversals, call spreads, bear spreads, puts, calls, so many strategies that you can use throughout the life of the stock, from the IPO day all the way to maturity stages. There are other reasons that you really need to add options to your portfolio as well, and these three are some of the most important factors. One of the number one factors is defined risk. In many of option strategies, you have limited downside. So prior to going into a trade, you know exactly how much you're going to lose. That makes it an ideal scenario for people who are a little bit more risk averse or having problem with their risk management skills. Second thing is cost efficiency. We're going to get to this a little later in the course, but you're going to realize very soon that options are extremely powerful and efficient when it comes to capital efficiency and cost efficiency. For every contract of option, it's equivalent of buying 100 shares of the underlying. So it's equivalent of using 1 to 10 leverage. And every time there is leverage, the returns are going to be magnified. So you have so much more upside in compared to just simply using the stocks. So limited downside, cost efficiency, and magnified returns are another reason that you need to add options to your portfolio. And lastly, and this is by far the most important reason why you should add options to your portfolio, is the third dimensions of options. So as I mentioned in this stock, stocks are really two-dimensional. You can either go long, betting that the stock will go up, or you can go short, betting that the stock can go down. But in the option world, there is an additional dimension, and we call it a speed. Which, by the way, by the end of this course, you will know exactly what we mean by speed. You can go long using options, you can short using options, but you can also bet on the speed of the market. So you can bet that the stock's going to consolidate and not do anything, or better yet, you can bet that the stock will either break out or break down. And that's the bet on the speed, which is the third dimension of the option market, which is making options very, very powerful, and at the same time makes it a little overwhelming for beginners. But don't worry, by the end of this course, you'll know exactly how to treat speed and the right strategies when you're betting on speed in the market. One of the other reasons that a lot of people get a little overwhelmed when it comes to options is the different strategies. There are so many. I mean, just take a look at my screen. So many strategies, so many different names. As a matter of fact, there are over 60 strategies in the option market, and not every one of them are helpful and useful. You have to define what is important for you. So in this course, we're going to focus less on the strategies, and we're going to focus more on a way of thinking about options and a methodology and what we want out of options. So rather than telling you how to use a butterfly or how to use a straddle or a call spread, I'm going to teach you exactly what it means and what you're really doing when you're setting up a butterfly strategy, or what you're really doing when you're setting up a vertical call spread. We're going to focus on way of thinking on options rather than simple names and simple strategies. What are you looking for to get out of the option market? Are you looking for some income in your portfolio, maybe your retirement? Then we're going to introduce cash secured puts. We're going to introduce covered calls. Are you looking to hedge your 401k? We're going to introduce protective puts. Are you looking to bet on some direction? There's tons of strategies for that. Are you stuck in a range in the market and you just want to bet that the market will continue trading in a range? Well, there's also tons of strategies for that. So rather than teaching you simple strategies, we want to focus on a way of thinking and how to think about options properly. The first step in options and understanding options is understanding option pricing. So there is calls and there is puts. When you're buying calls, you're betting that the stock will go up, and when you're buying puts, you're betting that the stock will go down or depreciate in value. But how much are you paying for your options? How can you look at the value of your option and think that you're getting a good value out of them? So let's talk about, in this first video, let's really hammer down the concept of understanding option pricing. Each option price that you see on your option chain is a byproduct of two aspects: intrinsic value, which is option strike price minus the underlying asset price, and extrinsic value. So this is the value that is not intrinsic, and few elements play a role in it. Just to name a few, one of the factors is volatility. One of the factors is time. One of the factors is interest rate. One of the factors is dividend that I didn't put in there. And all of these are Greeks that we're going to cover in the next class, so don't get overwhelmed. So let's go ahead inside an option chain and look at some of the pricing and see if we can figure out the price is because of intrinsic value or extrinsic value. So what you're seeing on my screen is a very common option chain. A majority of option chain, regardless of the platform that you're using, will look something like this. You have right at the money options, right in the middle of the option chain. So in this case, for this security, right here is where the stock is trading at, right at the money. This is an example of interactive broker option chain, and you can see the current price right at the top right hand corner. On the right hand side, you have your puts. So if you're betting that the stock's going to go down, you should look somewhere in here in the option chain. In the left hand side, you have your calls. If you bet that the stock's going to go up, you should look on this side of the option chain. So let me show that one more time. You have your calls on this side, and you have your puts on this side. If you want to bet that the stock's going down, you want to look in this area. If you want to bet that the stock's going up, you want to look in this area. Last thing to know when you're looking at the option chain is the shaded area and what it means. So the shaded area here means that these are in the money puts. So these are the puts that are already in the money. The shaded area over here are in the money calls. So these are calls that are already in the money. So this is also another important factor you need to know when it comes to options. But let's get into pricing. So let's look at those in the money calls that I just mentioned. In the money calls over here. So this call over here at 322 is trading at $12.42. What is the stock currently trading at? The stock is currently trading at $332, $333.85 right here. So if we take the 322, which is the strike price, minus what the stock is currently trading at, we can get the intrinsic value. So intrinsic value of this option that is trading at 1242 is 1185. So that's the difference between the strike price versus what the stock is already at, 1185. But wait a minute, the option is trading at 1242. So where is that difference coming from? Where is that 57 cents difference coming from? Well, that's the extrinsic value of the option. So recall on the last slide. Let's go to the last slide. Recall on the last slide how I said there is intrinsic value, which is the option strike price right here, minus the underlying asset, and there's extrinsic value, which is based on volatility, time, borrowing costs, dividend yield, and some other factors. Well, so let's go ahead to next slide and see if we can really realize where is this 50 cents coming from. So in this case, for this option, the intrinsic value is the strike price minus what the price is trading at. So you got 1185 over here. That's the intrinsic value. And the extrinsic value is the difference of what the option is trading at. So it's 57 cents. Where is this 57 cents coming from? Some of it is coming from volatility, how volatile the market is. Some of it is coming because of time. So this option has 5 days to expiry. And because it has 5 days to expiry, it is very important. It gives it value. It adds value to it. Some of it is because of where the interest rate is at. Some of it might be because the stock is about to pay dividends. So all of these factors play an important role. In this case, it pays 57 cents. All of these factors combined are contributing 57 cents to the price of that option. Let's take a look at a way out of the money call. So out of the money call in this case is 348 in the option chain. Look at what it's trading for. About 6 cents. So is there any intrinsic value in this option? Not really, right? This is 348 minus 334. The number is going to be negative. So there's no intrinsic value of this option. So all this 6 cents is all extrinsic value. the further you go out in the option chain, the less and less valuable the call options are going to be. So the further you go from in the money, the further you go your distance, the less value your options are going to have. Same story in the put. The further you go away from in the money area, so remember I mentioned the shaded area is in the money, the further you go from in the money area, the cheaper the options get. So in this case you can see they go from $2 all the way to only 53 cents. So the cheaper and cheaper and cheaper they get. Welcome to class 2 of option trading for beginners. In the last class we talked about what are options and why they're so powerful and why you should learn how to use them. We talked about capital efficiency, concept of leverage, and so many other things. And lastly, we talked about how to price options and what is the intrinsic value of an option versus the extrinsic value of an option. But here's what you can expect in this class. We're going to talk about calls, puts, and buying versus selling options. We're going to spend about 5 to 6 minutes talking about payout diagrams, understanding what is your payout if you buy a call and what is your payout, your potential payout, if you sell a call. What is your payout if you buy a put versus what is your potential payout if you sell a put. And we're going to spend a few minutes on margin impact. And this is one of the most important areas. Options are inherently risky and they require margin. That means excess cash that your broker needs to know you have in case things don't go as planned. So we're going to spend a few minutes on margin impact as well. And hopefully by the end of this session, you have a really good basic understanding of what options are, how to price them, and what they mean when you sell an option versus you buy an option. Let's get started. Let's spend a few minutes understanding option payouts. So major payout diagram can be seen in the picture over here in the TV next to me. Combining these buying and selling options can create really complex strategies. And trust me, we are going to get to some of those. But these are the most basic and building blocks of your option career trading journey. Let's start with buying calls. Remember, buying a call, and every time you buy an option, it's an option to buy the 100 shares of the underlying at a specific price. It's a bullish bet, so you're betting that the stock will go up. Let's start with buying a call and what it means. When you buy a call, you have the option to buy 100 shares of the underlying stock at a specific price. It is a bullish bet. So if you assume that on the left-hand side we have your P&L and potential money that you can make, when you buy a call, for every dollar that the stock goes up, this is the price, for every dollar that the stock goes up, you can make a lot of money. As you can see, this will continue to go up. And what you have is unlimited amounts of gain that you can make. In case of worst case scenario, you're going to lose the premium that you paid for that option if the stock actually goes down. So this is kind of your worst case scenario. Let's go to the other side of the spectrum, buying puts. Buying puts is a bearish bet. It's an option to sell the underlying 100 shares of the underlying at a specific strike price that you choose. As you can see, if this is again your P&L, for every dollar that the stock goes down, you end up making money. Over here, your maximum profit is capped, because theoretically, the worst case scenario is the stock going to zero. Stock can't really go negative. So your maximum profit is capped, but also your maximum loss is capped. What does that mean? If the stock actually goes up and you end up buying puts, in the worst case scenario, you lose all the premium that you put forward. So going into the trade, you know exactly how much you're going to lose. This is amazing for beginner traders who have a trouble with understanding risk management. Prior going into the trade, you know exactly how much you're going to lose. On the other side of the spectrum, we have selling calls. Now this is where it gets tricky. Every time you sell an option, you have the obligation. So it's no longer an option, but an obligation. We're going to spend a little bit more time really honing on these ideas. But selling a call is also a bearish bet. So when you sell a call and the stock goes down in value, you end up collecting all the premium that you sold. Your P&L is capped. The maximum is the amount of premium that you collected. And in the worst case scenario, if the stocks start going up, your downside is unlimited. This makes it pretty risky for beginner traders. Every time we're selling an option, there is inherent risk involved. That's why today we're going to spend a lot of time on understanding margin impact and what it actually means. Again, on the other side of the spectrum in terms of selling, we have selling puts. This is a bullish bet. So if the stock goes up and continue to go up, you end up collecting all the premium that you collected when you sold the put. Your max is capped. This is the maximum. Your P&L is based on how much premium you collected. And in the worst case scenario, you're going to get assigned, have to buy the underlying shares, and you're going to go dollar for dollar in the losses involved. If these payout diagrams are a little bit complicated for you, don't worry. By the end of this course, we're going to do so many practice problems and so many examples that you're going to memorize all these payout diagrams without even thinking about them. So let's go ahead and look at a simple example. Let's look at a chart of the Apple. Let's imagine you're more of a technical analyst and you believe you're seeing a cup and handle over here in an Apple chart. And you believe this is going to be pretty bullish moving forward over the next few weeks. As you recall from the last slide, when we're bullish, there's a couple of strategies that we could use. One of the simple ones is simply buying call, and the other strategy is selling puts. Both of these strategies are quite bullish. There is a little bit of a difference, but we'll cover them in the next classes. But for now, you know you have two strategies at your discretion: buying calls and selling puts. Let's go ahead and talk about buying calls. Let's imagine you're bullish about Apple and you think Apple over the next week is going to go up maybe back to the 170, somewhere around here. So you go ahead and buy some calls. How does your payout would look like? This is what your payout diagram is going to look like. So for $147 call, for dollar, if Apple continues to go up, you can make more and more money. You're spending $475 for this one contract, so that's $475, and your break-even point is $151.75. That's the difference between how much you paid for that call and the current trading price of Apple. You add these two together, and at the time of expiry, for every dollar that Apple is higher, you're making money. So let's say we're a little bit optimistic and we believe Apple is going to go to $180. How much are you going to make? Simply just draw a line from 180 over here, go all the way up, and you can see a small investment of $475 can lead into over $3,000 in profit. Recall from the last class that I told you options are extremely capital efficient? Well, there you have it. You invest $475 and you have the opportunity to make $3,000, almost 6 times of your initial investment. Let's go ahead and look at another example. Let's say this time, instead of being bullish, you're actually bearish. So let's look at the Amazon chart. And let's say again, you're a technical analyst, you're looking at the chart, and you see this shooting star doji over here. And you believe this is a big signal that Amazon stock is going to fall over the next few weeks. So what are some of the strategies that you can use if you're bearish on Amazon? Let's go back to the previous slide and see if you remember. There are two strategies. You can sell calls. So if the stock goes down, you get to keep all the premium. Or you can buy puts. So if the stock goes down, you get to make more and more money. Again, we want to keep it simple today. So let's just focus on a simpler strategy, which is buying puts. You go ahead and buy one contract of $113 put for Amazon. You pay $4.60 for this contract, and as you can see, as the Amazon stock dropped from $114, let's say down all the way to $90, as you can see over here, you're making more and more and more and more money. Again, as you can see, if you're right about the direction and Amazon actually go to 90, your investment of $460 can yield you over almost $2,000 in profit. Again, proving my point from the previous class that options are extremely capital efficient. Another thing to note here, similar to buying calls, every time you're buying an option, let's say buying a call or buying a put, your downside is limited. You know exactly how much you're going to lose. In the worst case scenario, you're going to lose the amount of premium that you paid for that option. Why? Because it's an option, right? We said for calls, it's an option to buy the underlying, and for puts, it's an option to sell the underlying. So let's talk about margin impact. This slide by far is the most important slide in this course. You have the PDF format of these classes available, so I recommend printing these out, and especially this slide, and put it on your wall. When you're a call seller, you have the obligation to sell the stock at the strike price at the expiry. When you're a call buyer, you have the option to buy the stock at strike in expiry. When you're a put seller, you have the obligation to buy this stock at the strike price at expiry. And when you're a put buyer, you have the option to sell the stock at a strike price at the time of expiry. Do you see a pattern here? Whenever you sell an option, you're obligated. Whatever is call seller or put seller, you have the obligation to buy or sell the underlying stocks. So whenever you're obligated, that means you need to put more money up front, and you have to use your margin account. And that's where it becomes a little tricky, and that's where the losses become really large for beginner traders. So buying options, whenever you're buying an option, you have the option. There is no obligations. But whenever you're selling an option, there is an obligation. So in a worst case scenario, let's say you sold some puts on Apple, you have to have enough money to buy 100 shares of Apple for every contract that you sold. So understanding your risk and your risk management becomes really important. Let's go back and show you this with that Amazon example that I told you. As you can see, buying put on Amazon and selling call on Amazon get us the same result. So in this case, if Amazon goes down, we make more and more and more money. This is our P&L. We make more and more money. And in this case, if Amazon goes down, goes down, we make all the premium. We don't make more money, but we're making a constant amount of money. We capture all the premium that we sold. Do you see a difference here? There are two key differences. So maybe pause the video and see if you can recognize the differences. The difference number one is that when you buy put, you're being more aggressive. You're not capping your upside. Whereas when you sell a call, you're capping your upside. So you're being less aggressive. Both of these strategies are quite bearish, but one is more aggressive and one is less aggressive. The second difference is margin impact. When you're buying put on Amazon, your margin impact is zero. But when you're selling call on Amazon, your margin impact is at around $5,000. Why is that? Because when you sell an option, you're obligated to do that transaction by the time of expiry. So in this case, when you sold some calls on Amazon at 114, you're obligated to sell 100 shares of Amazon at $114 at the time of expiry, if it is above or at 114. So in that case, you can see if a good news comes out and Amazon gaps up and goes to $130, $140, your losses become a lot bigger and a lot bigger. So understanding margin impact is really important. A rule of thumb for margin impact is about 30% of the buying power you require to either buy or sell 100 shares of underlying. So in this case, for Amazon, 100 shares of $114 call would be about 11,000 capital commitment. And your broker most of the times requires to put down at least 30% of it in case the trade goes south and goes against you. So let's recap what we learned today. We talked about what it means to buy a call, what it means to buy a put. We talked about what it means to sell a call and what it means to sell a put. We spend a lot of times on payout diagram and how does your P&L changes if you're buying a call versus you're selling a call. And we also spend some time on margin impact. In the next class, we're going to talk about Greeks, delta, gamma, some of the important Greeks that you need to know. We're going to talk about volatility and VIX, open interest, and volume. As you can see, as we progress, we're getting a majority of the meat of the option trading out. And once we're done with the fundamentals, we can get into some strategies. Hi, welcome back to class 3 in the series of option trading for beginners. What to expect in this class? We're going to talk about the Greeks. Now the Greeks get a lot of bad rep. People find them confusing, a little overwhelming. But in this class, we're going to focus on the key Greeks and what you need to know from them and what you need to actually forget. See, option tradings can actually be really easy. A lot of people make it complex, but the genius is in keeping it simple. We're going to talk about the Greeks. Most specifically, we're going to talk about delta, gamma, vega, and theta. We're going to talk about the time decay a little bit more, and we're going to spend some time on liquidity. What is open interest? What is volume? If you recall this slide from the class 1, we talked about option pricing and how some part of the option is the intrinsic value, that's the option strike price minus the underlying asset price, and some of it is the extrinsic value based on the time to expiry, the volatility of the stock, the borrowing rate, the dividend yield. And I told you there was a little asterisk on the chart over there that it says these are the parameters used in Greeks, the so-called Greeks that are used in Black-Scholes model. But let's get into them and actually introduce them today. So if you recall again from this slide from the previous class, we said for an option that is deep in the money, like this option at 322, if this option is trading at 1242, the difference between the current price and what the option is trading at is the intrinsic value. So in this case, 1185. But the option is trading at 1242. So 57 cents of it is extrinsic value based on how much time there is to expiry, what is the volatility, of the security, what is the delta, and things in that nature. And in this case, for this option that is so out of the money, the price is 6 cents. There is no intrinsic value of this option, and all this 6 cents is coming from the time, the volatility, and things in that nature. So, what are Greeks? Let's talk about the most important ones, and I'll give you some examples that you really understand them very well. Delta. Delta is the change in the price of option for every dollar move in the underlying asset. An easy way to think of it is probability of the option ending in the money. And I'll show you a lot of examples in the next slide. Gamma is the derivative of delta. So it's basically a rate of change of delta. It is the things that you need to know about gamma is that it's highest when the option is at the money and near expiration. Gamma is mostly used for market makers. Over the few years, you probably have heard the term gamma squeeze that happened with GME, the GameStop stock. So gamma is one of the key parameters market makers use. So as a retail trader, you should know what it is, but you shouldn't really concern yourself with it. Just know that gamma is the rate of change of delta. Theta is the rate of time decay. Options have intrinsic time value in them. And every day that goes by, a little bit of that value gets taken out. And vega is measure of implied volatility. When you buy an option, you're paying for volatility, so you have a positive vega. And when you're selling an option, you're shorting volatility, so you have negative vega. Let's take a look at a couple of examples. Let's look at Netflix from July 22nd, 2022. As you can see, if you select this option over here, which is right at the money, 222.50, the delta of this option is 0.5. So for every dollar that Netflix goes up, this option becomes more valuable by 50 cents. So it goes from 180 to somewhere around 220 to 230. So the price. Another way to think of it is this option has a 50% chance of finishing in the money. Notice how right at the money options usually have a delta of 50, meaning it's almost a coin toss whether or not they finish in the money or out of the money. Another thing that you need to look at is the theta. The theta here is negative 180. So what does that mean? That means every day that goes by, $1.80 comes out of this option in terms of value. In this case, it makes a lot of sense because this option is expiring today. This is a 0 day to expiry option. So by the end of the day, of course, this option is going to have no value and it's going to expire. So looking at this option chain, the delta is 50, the theta is 189, and the vega, if we're buying the option, is positive, and if we're selling the option, is negative. Let's take a look at another example. This time, we're going 1 week further, 7 days. And we're using an option that is slightly in the money. So option is trading at 222, but here we're picking an option that is slightly in the money at 212. In this case, delta is 74. So for every dollar that Netflix goes up, this option becomes 74 cents more valuable. Another way to think of it is the probability of finishing in the money. This option has a 74% chance to finish in the money. As you can notice, the deeper you go in the money, the higher your delta is going to be. And a delta of 1 means for every dollar change in the underlying, in this case Netflix, the option becomes $1 more valuable. Or that option has a 100% chance of finishing in the money. The theta of this option over here is only 39 cents. Why is that? Because this option still has 7 days to expiry. So every day that goes by, this option loses 39 cents in value. So let's recap again. The delta is 74, 74% chance that this option will finish in the money, or for every dollar change of Netflix, there's going to be a 74 cents appreciation for the option contract. The theta of 39, and the vega of positive if you're buying the option, and vega of negative if you're selling the option. Now let's spend some time on theta and time decay. While looking at the option chain, the theta seems linear, every day 39 cents in this example. The reality is theta doesn't actually move in a linear fashion. In the beginning, it moves really slowly. And near the expiry, and for at the money contract, it becomes exponential. And at the very end, it becomes linear again. So it starts linear, I put an L as a linear, it finishes linear. And during the bulk of the expiry, it becomes exponential, especially for at the money contracts. Those contracts lose their value really quickly. So let's spend a little bit more time on this slide as well. As a buyer of an option, time is working against you, especially when the speed is accelerating. So if you buy a call option on Apple, and let's say Apple currently is at $150 and you buy a call option for next year at $200, every day that goes by and Apple is not getting closer to $200, you're losing value. On the other hand, if you sell option, as a seller of an option, time is working for you. So let's say in this case you sell a 200 Apple call. Every day that goes by and Apple is not getting closer to that 200, the option is gaining value. And more expires every day, gaining more value to the option that you've sold. So time is working for you rather than against you. Let's talk a little bit about option expiry and settlement. These are a little boring, but every option trader needs to know this. So bear with me. Option expiries are usually third Friday of every month. We also have weekly options, which are every Friday for more active stocks. Indices usually have Monday, Wednesday, and Friday expiries, and recently we even introduced daily options for SPX and NDX. There are AM and PM settlements, but the majority of the options that we trade are PM settled. So they're settled after the market close. So be careful if you're trading those contracts, make sure to close them before the close. XSP is 1/10 of the size of SPX, and MROTH is 1/10 of the size of Russell 2000 if you have a smaller account and you want to trade those indices. But make sure to know that they're European style. Now, the options could be settled in cash, which is the difference, or the actual shares of the underlying stocks. Options could be European, which means they only are exercised at expiry, or American. They can be exercised at any time when in the money. Be aware of American style expiries for dividend stocks going ex-dividend. That is usually the only time you might get early assignment if you've sold some calls, because the person who has bought the call wants to change it into stocks to make sure he or she gets a share of that dividend. So be mindful of early assignment, especially for the stocks that give out dividends. Majority of the stocks that you trade, especially in the US market, are going to be American style, so they can be exercised at any time. But early assignment shouldn't really be a big concern for you, as only stocks that are going ex-dividend usually get early assigned. Let's talk about liquidity. It is important to understand that option market is not as liquid by nature. When choosing this strategy, pay attention to the bid and ask spread. The longer the duration of the option, the bigger the bid and ask spread are going to be. Of course, not always, but this could be a good overgeneralization. So take a look at this option. That is 767 days away, so plus 700 days away. When you look at this option for something that is way out of the money, you can see that the spread is $4.50. And remember, for option contracts, you have to multiply them by 100. So that means you're just losing instantly $450 to the bid and ask spread. So pay attention to the liquidity and how far you're going out in the time. Now, let's talk about option open interest and volume. Volume and open interest are two key technical metrics that describe the liquidity and activity of options and the future contracts. Volume is an important measure of strength and interest in a particular trade. The volume and open interest metric provide information about the level of buying and selling the underlying and a potential price move. Volume reflects a running total throughout the trading day, and open interest is updated just once per day. So open interest is number of contracts that are active and not settled yet, and volume is number of contracts traded in a given period. So let's go ahead in an option chain and take a look at open interest and volume. A lot of the trading platforms show you the open interest for calls, puts, and for puts and calls combined. This is the open interest for Netflix. As you can see, there tends to be more open interest on round numbers like 180 and 220 and 250. There's usually more open interest at the round numbers. Majority of the time, these massive open interests act as a magnet and bring the price closer and closer to them. There's a reason for that, and it's based on market makers and the way they hedge their gamma, but the scope of this conversation is too complex for this course. But just know that as an option trader, you need to pay attention to the volume and open interest. Few key things to note. A rise in option price without corresponding rise in the stock price results in an increase in option contract implied volatility. We're going to talk a lot about implied volatility in the next class, by the way. When the volume exceeds open interest on a given day, it suggests that trading in that option was exceptionally high that day. Open interest also gives you a key information regarding the liquidity of an option. When analyzing changes in option volume, volatility, and volatility skew, it is important to consider the changes in open interest. A large volume on option contracts does not necessarily mean there is an increase in interest regarding the stock. In fact, sometimes it may be the opposite. So let's go to that option chain and take a look at it. Every option chain, usually on your left hand side, you can see the open interest and the volume. So for example, for Netflix, the 200 strike price has 1,700 open interest, and about 352 contracts were traded that day. In some strike price, you note that the volume is larger than the open interest. Like in this case, for 230, there is more volume than there is open interest on the 230 strike price. That shows that a lot of the market participants are buying 230 calls for a stock like Netflix. And sometimes this massive volume can lead into the stock rallying because of the phenomenon called gamma hedging that the market makers do. So paying attention in the option chain in volume and open interest is really, really important as a beginner option trader. So we covered a lot of stuff today. We talked about the Greeks, the delta, the gamma, the theta. We talked about time decay, and we talked about liquidity of an option. What does open interest mean? What does volume mean? And after that, we're going to start introducing some key strategies for beginner option trader. I'm really excited for you guys. We're really laying some amazing foundation of your option trading journey. We'll see you in the next class. Hi, welcome back to class 4 of option trading for beginners. If you ask any option trader that what is one key factor in their success, almost all across the board will tell you it's understanding implied volatility. Today's session is going to be about implied volatility. And in my personal opinion, if you understand this class very well, you're not going to have any problem moving forward in your option trading journey. So, what to expect? We're going to define what volatility is, and we're going to differentiate between realized volatility and implied volatility. We're going to spend a lot of time on what implied volatility means, when you should buy volatility versus when you should sell volatility. And of course, we're going to talk about wicks, or the 30-day implied volatility of S&P 500. So let's get started. What is volatility? As I said, there's two types of volatility: realized volatility, what has happened in the past, and the implied volatility, what is going to happen in the future. The definition of realized volatility is basically the standard deviation of price returns, but let's not overcomplicate things. It's basically telling you how much a stock is expected to move. So a 10-year volatility history of Apple shows you very low volatility years from 2012 to 2019, which, by the way, Apple stock did really well. And the 2020, all of a sudden 21.75% volatility. Can we remember something crazy that happened in 2020? Of course, it was the COVID crash and the lockdowns. So that just shows you that the return of Apple volatile and move by 21% throughout that year. So again, realized volatility is looking at the past. So the stock of Facebook going up, going down, going up, going down. The earning happens, going down, going back up again. All these movements is calculated in realized volatility. And recall that realized volatility is focusing on what has happened in the past. It's a deviation of return from the mean. But as option traders, do we care more about the past, or do we care about what's going to happen in the future? Well, of course, the future. We want to know where the stock is going. And in order to do that, we need something called implied volatility. A really good measure of historical volatility, by the way, that a lot of day traders and swing traders use is ATR, or average true range. That calculation is completely from what has happened in the past. And some traders use it to make trading decisions. If you ever wonder what the ATR of a stock is, you can simply go to Trading Terminal, look up the stock, and you can see the ATR right at the top part. But as traders, as I said again, as option traders specifically, you care about future and not the past. So for that reason, you want to know where the Facebook stock is going. A lot of the brokerage firm will give you something like this, that is kind of a pattern of where they think the stock is going to be. And you can do this for any stock. This is from Interactive Broker, by the way. So the platform is telling you there is a 70% chance that Facebook will be between 189 or 235 by May 20th of 2022. How is Interactive Broker estimating this? Is this magic? Where this number is coming from? Can you guess? Well, you guessed it right. It's coming from implied volatility. How the price is going to move in the future. Implied volatility unit is usually in annual formats, and it's driven from what's happening in the option market. So if you open up any option chain, you should be able to see the implied volatility on it. Recall that implied volatility is always quoted in annual format. So if you want the weekly, the daily, or monthly volatility, you need to do some calculation. For monthly volatility, you simply divide it by root square of 12 because there's 12 months in a year. For weekly volatility, you simply divide the analyzed volatility by 52 and you get the weekly volatility. Why are we dividing by 52? Because there's 52 weeks in the year. And for daily volatility, you simply divide annualized volatility by root square of 252. Why 252? Because there's 252 trading days in the year. And you can use this number to calculate the expected price of any stock in the day, in the next week, or even in the next year. VIX is simply the 30-day implied volatility of S&P 500. So let's use those formulas and really see where do we think the S&P 500 or the ETF that represented, the SPY, is going to go. So what does it mean when the VIX is at 29.25? What can VIX really tell us? You can look at the SPY and look at the VIX and really predict where the SPY is going to be over the next 30 days. Of course, a lot of the platforms, especially Interactive Broker, do this calculation for you, but you can use the 30-day implied volatility and make that calculations for yourself if your brokerage firm doesn't do it. So let's actually take a moment and do this practice problem together. If the volatility or VIX is 29, we know that the volatility is 0.29, 29. Volatility is always quoted in an annual format, but we know VIX is the 30-day implied volatility. So we have to turn it into a monthly volatility. So you simply divide this by root square of 12. Now you get the monthly volatility. If you multiply this by the current price of a SPY, so a SPY in this case is 417, multiply that by this number, you get plus or minus a range where the SPY is going to be. So in this case, SPY will be somewhere around 458 or 382. It's just this calculation. Don't worry, in the quiz section, I'm going to ask a couple of questions to make sure you really understand how to change annualized volatility into weekly volatility or daily volatility, and how to calculate these price movements for any stock, not just S&P 500. One last thing I want to let you know about VIX and volatility as option trader is overall, you want to remember during high volatile times, you want to be the seller of option. When volatility is high and expensive, you want to sell it. And during low volatility time, you want to be buyer of the option. Also, another thing to consider is when the VIX and volatility is low, usually the stocks are going up. And when the VIX or volatility is high, usually stocks are going down. This relationship doesn't always hold, but you can think of it as a negative correlation. When the VIX is down, the stocks are going up, and when the VIX is up, the stocks are going down. When the VIX is up, you want to be the seller of the option, and when the VIX is down, you want to be buyer of an option. These are key things to know about implied volatility. We could do hours and hours and hours on implied volatility, and actually if you want to take the advanced option trading course, we're going to spend a lot more time on implied volatility, skew, and so many other factors. But for now, just know these basics. If you can understand these basics, that's 90% of option trading. So, in summary, implied volatility is the output of option pricing model. It is a guide and compass of how stocks are going to move. If the implied volatility is going down, the stocks are probably going to go up. If the implied volatility is going up, the stocks are probably going to go down. It is that third dimension of option trading that we talked about in the first class. It is the speed of the market. Understanding the implied volatility will dictate your strategy. Do we want to short volatility? Do we want to go long volatility? When do we want to go long volatility? When volatility is cheap, when VIX is low. When do we want to short volatility? When volatility is expensive, when VIX is high. These are some of the key basic things to know when it comes to implied volatility. Alright, so I have about 5 questions in the quiz section about implied volatility. Make sure to do them and really understand this concept. Now that you know about volatility, the Greeks, the option pricing, and basic call and put and margin requirements, you're ready to start a little bit more complex strategies. Over the next few classes, I'll introduce cash secured puts, covered call strategies, as well as 4 vertical strategies that you can use. And that concludes our option trading basic course. Hi, welcome back to class 5 of the series Option Trading for Beginners. So far, we've talked about what options are, their intrinsic and extrinsic value. We spend a lot of time on payout diagrams, implied volatilities, and the Greeks. So now, let's get our hands dirty into some strategies. We're going to talk about some key bullish strategies such as buying calls and selling puts. We're going to talk about some key bearish strategies such as buying puts and selling calls. And we're going to discuss when to use which strategy depending on what you're seeing on the chart as well as what you're seeing on an implied volatility basis. So let's get started. Let's take a look at Apple's chart. Let's imagine, for whatever reason, you're bullish on Apple. It could be based on a technical, you believe that the stock has rallied, is going to pull back, and then continue its move higher. It could be based on a fundamental level. We're not really focused on that for now. We're mostly focused on the fact that we're bullish on Apple stock. Well, if you remember, there's 2 key categories that you could do. You could either sell some puts or buy some calls. So let's start with the first one, buying calls. For at-the-money call for an option like Apple, which is currently trading at $152, you can buy a contract, or in this case, about 10 contracts, and your payout diagram looks something like this. If the Apple goes up, dollar for dollar, you're gonna make some money. Two key things I want you to pay attention to. Take a look at your profit probability and your margin impact. As you can see, there is no margin impact because if you recall from the previous classes, every time you're buying an option, it's just an option and not the obligation. So your margin is not really being impacted in that transaction. So the worst case, in this case, when you're buying Apple calls, is that Apple doesn't go up and you lose all your money, nothing else. So your broker doesn't really require you to put up some more money. And another thing you want to pay attention to is the profit probability. On average, every time you're buying an option, it's a lower probability transaction. So you want to pay attention to that as well. So let's imagine that you believe that Apple is going to go up and you bought 10 contracts of $152.50 call and you spent about $4,000 on it. So the break-even point is if by the time of expiry Apple moves more than what you paid for that contract, which in this case is about $4 per contract. So for every dollar that Apple is above 156, you're gonna make money. So right around here is your break-even point, and for every dollar you're gonna make money. So let's imagine if Apple goes to $160, or move by 5%, you're going to make about $4,000. If Apple goes to 163, you're gonna make over $6,000. So let's take a look at your potential payout. So if Apple goes to $160, you're gonna make $6,000 with 10 contracts, which is costing you about $4,000. So as you can see, $4,051. That's a 50% return in just a few days. If you're wrong, however, and Apple goes below 152.50, which is the price over here, the price Apple currently trading at, you're gonna lose all your investment. So you're gonna lose $4,000. So yes, options and buying options, whether you're buying calls or buying puts, is amazing during good times and can be devastating during bad times. So you need to have proper risk management in place. So now let's say you're still bullish on Apple. So the same chart of Apple, and you're still bullish, but this time not as much. So you don't believe that the stock is gonna rally higher, maybe to 163 or 170. All you believe is that the stock's gonna consolidate or slightly move higher. And this level over here that has been tested a couple of times on a technical level is going to be respected and protected at around 150. So this time around, instead of buying calls, you could do something else. You could sell puts. So you could go ahead and sell some $150 put. Again, in this case, you can sell 10 contracts of $150 put. And if you're right about your strategy and Apple stays above 150 by the time of expiry, you get to keep all the premium. So in this case, $2,555 for 10 contracts. But if you're wrong and Apple comes down, dollar for dollar, you're gonna lose money on this trade. One of the reasons this happens is that when you're selling a put, you're obligated to buy the underlying. So your brokerage assume that you're long Apple from 150. So if Apple goes to 145, you're losing $5 per contract, which in this case would translate into a $500 loss per contract. And again, in this case, you have 10 contracts, so a $500 loss would be around $5,000 loss. So you need to really pay attention to these. A couple of other things I want to bring your attention to. Compare the profit probability over here with what we just saw earlier. Over there it was about 36%, and now here is about 73%. So every time you're selling premium, in this case selling puts, you have a higher profit probability. But take a look at another thing. Look at your margin impact. Basically, your brokerage is asking you to put up $58,000 of cash in order to do this $2,000 transaction. So your broker is basically telling you have to put enough money to be able to buy 1,000 shares of Apple. So in this case, 1,000 shares of Apple is about $150,000 investment, and your broker wants you to put at least 30% of this. If you need some refresher on margin and margin impact and how it is calculated, make sure to go check out the class 1, 2, and 3 prior to coming to this class. So let's recap. Key things to remember. If you're bullish on a stock, you should buy calls. If you're neutral to bullish and not sure about the speed of the move, you should sell puts. Buying calls have unlimited potential and limited downside. Let's go and take a look at this and see what I actually mean exactly by this. So as you can see, buying calls, you have a limited downside, you know exactly how much you're making, and you have an unlimited gain potential. So this risk to reward comes at a price. What is the price? A lower profit probability. Selling a put on the other hand, has limited potential and unlimited downside. So let's go back to the chart and see what we mean by that. When you're selling a put, your maximum profit is limited. It's capped to the premium you're going to collect, in this case about $2,500. But your loss is going to be unlimited because it assumes that you're buying Apple at $150, and theoretically Apple could go to zero and you could lose a lot more money than you put forward. Selling premium has higher probability of making money but poor risk to reward. So let's go ahead and look at that. Over here you have a 73% chance of making money, but you're only making $2,500 in the best case scenario, and a poorer risk to reward. On the other hand, buying premium has lower profit probability but higher return potential. So you can even see it in this chart. About a 35% chance that your Apple calls make you money, but you have unlimited max return. So probability of a trade making money versus its risk to reward is basically the trade-off in option trading. That's when you need to decide if you want to buy call or sell puts, if you're bullish on a trade. So let's go to our simulated trading account by Interactive Broker and actually show you this in real life. You have your option chain here. Let's bring up Apple. So I put in the ticker on the left hand side. Let's bring up Apple. And you can see that this is the option of Apple. So if you're bullish, you go ahead and you buy some calls. So let's go ahead and buy some calls over here. Buying a call, it comes into your montage. You can set the price that you want, click on buy, and click on the quantity that you want. Let's say 10 contracts, 9 contracts. And then you can easily submit your trade to the market. Again, on the other hand, if you're still bullish on the trade but you don't want to be aggressive, you can simply sell puts. So in this case, you can sell the 150 puts. So it will be on the right hand side of the option chain. Click on the sell, and now you're selling the contract. And then you can pick your quantity, 5, 6, 7, 8, 9, 10, depending on how much you want, and you can simply submit your order. As you can see, when you press submit, the platform will show you what is your maximum profit, what is your profit probability, what is the maximum return you're going to make, and how would your payout look like in case the trade goes against you. So in this case, if the Apple is staying above 150, you get to keep all the premium, and if Apple goes down, you get to lose a lot of money. Let's go ahead and do that for buying Apple calls as well, just so I can show you. So in this case, at 150, you go ahead and buy some 150 calls. Let's go ahead and pick 9 contracts, press submit. And let's click on performance profile and take a look at how the performance profile look like. So very similar. If you're right and Apple goes above 150, you are going to make a lot of money. So in this case, dollar for dollar. In this case, dollar for dollar, you're going to make money. Your max return is unlimited because the more Apple goes up, the more money you're going to make. And your max loss is defined at how much premium you paid. So in this case, 9 contracts. For each contract you paid about $4, $5 I believe, and which is about $400, and it comes to $6,000 max loss. So pretty simple executing these option transactions. Again, this is a platform by Interactive Broker. You can see the option chain, you can see your montage where you can take the trades, you have your watch list, and all the necessary information you need as an option trader. So let's go back and now imagine you have a bearish thesis, and how can you play that? For this case, let's take a look at Amazon. So you can see Amazon, a massive bearish candlestick. Again, this could be based on a fundamental thesis, whether you think economy is slowing down and people are not going to order as many Amazon, or it could be based on a technical thesis. So based on technical analysis, you're seeing lower lows and lower highs, and you believe that Amazon is going to come down lower and test the previous lows of earlier in the month in July. So how can you do that, and how can you set this trade up with options? Well, similar to being bullish, you have 2 options. You have buying puts or selling calls. Let's start with buying puts. Again, in this case, you go ahead and buy your puts. You buy 10 contracts of Amazon put right at 116. Again, take a look at here. Lower profit probability because you're buying an option. So every time you're buying an option, your profit probability is lower, but your gain potential is higher. It's that trade-off that I talked about. And take a look at your margin impact, 0. since you're paying for the premium, you already know how much you're going to lose, so your broker doesn't require you to put up more money and put up more collateral. So you definitely need to pay attention to that. So in this case, for every dollar that Amazon goes lower, you get to make more money and more money. So if Amazon go to 100, you probably make around 12.5K. So let's take a look at this. If Amazon tests the previous lows, which is around 100, you'll make about 14,000 on a 2,200 investment. This is a 500% return, over 500% return in just a few days. However, if you're wrong and Amazon goes above 116, so in this case, if Amazon actually rallies and goes up in price, you're gonna lose all your investment. So in this case, you're gonna lose all your $2,000. So you need to pay attention to these risk to rewards and really understand the profit probability. Yes, options are really powerful because they're inherently leveraged, but leverage is a double-edged sword. So you can make a lot more money, but you can also lose all your money. So now let's take a look at this chart again and say you're still bearish, but you're not as bearish as the previous thesis. So you don't think that Amazon's gonna fall down like this, but rather it's probably gonna consolidate and maybe slowly go lower. So in this case, you're more neutral / bearish rather than full-on bearish. So in this case, you can simply sell some calls either at this support level where the doji has been touched right around here, or simply at the high of previous day candle, so right around here at 120, 122. So let's take a look at the performance profile for this transaction and the risk to reward together. So in this case, you're saying Amazon, whatever happens to Amazon, Amazon will be below 120. So you sell 10 contracts of Amazon. So if Amazon stays below 120, you get to keep all the premium that you sold, which is around $5,000, 4,851. Again, pay attention to profit probability. Because you're selling premium, this is a higher probability transaction. But there is an unlimited amount of money that you could lose if you're wrong on your thesis. Take a look at margin impact and compare it with buying puts in selling calls. So if we go here, as you can see, margin impact over here is 0. And in this scenario, we're just buying puts. But now compare it with selling calls. And you can see the margin impact is 44,000. Why? Because the platform is assuming, because every time you're selling a call, you're obligated to short that stock at 120. So the platform is assuming that you're obligated to sell short 1,000 shares of Amazon at 120. So that's about $120,000 investment. So you have to put up at least 30% of it as a margin collateral. So the margin impact is at about 44,840. So you really need to pay attention to this risk to reward and profit probability. Key things to remember here: if you're bearish on a stock, you should buy puts. If you're neutral / bearish on a stock, so neutral / bearish, and not sure about the speed of the move, you should sell calls. Buying puts have limited potential because the stock could theoretically only go to 0, and limited downside. You're only gonna lose the premium you paid for. Selling calls, this is selling calls, my apologies, this has to be selling calls. Selling calls has limited potential and unlimited downside because you're short selling that stock. So selling premium has higher probability of making money but poor risk to reward, and you should always pay attention to probability versus risk to reward trade-off. So let's go ahead into the option chain and take a look at that Amazon trade together. So again, I'm going back to my interactive broker platform. I'm putting in the Amazon, AMZN, that's the ticker, and I'm seeing the option chain. Again, on the right hand side is your calls, on the left hand side is your puts. I'm bearish, so I want to buy some puts and I think the stock's going to go down, so let's go ahead and do that. You go ahead and buy some puts over here. You're doing 10 contracts. Each contract is $358, which translates into $358. You're doing 10 of those, so that's about a $3,500 investment from you. So let's go ahead and press submit and see how the payout diagram look like. Again, as you can see, if you're right on your direction and Amazon actually goes lower and lower and lower, you get to make a lot of money. So in this case, if Amazon goes to $55, you get to make $56,000 on this investment. So pretty powerful. Again, in the worst case scenario, Amazon goes up, you're wrong about your direction, and you lose all the premium you paid for. In this case, around $3,900. Now let's compare another trade. Let's say you are bearish, but you're not so sure about the speed of the market. So rather than being on the right hand side, which is for the puts, you want to be on the left hand side, which is for the call in this area. And you go ahead to 120 and you go and simply click on selling a call. So now it's like shorting Amazon at 120. Let's increase the quantity to 10, submit your order, and as you can see, now you have a higher profit probability of making money, about 64% to be exact. Your maximum return is limited. It's all the premium you collected if Amazon goes lower, but your maximum loss will also be unlimited. If Amazon rallies and goes higher, you get to lose a lot of money. Why? Because it's like shorting Amazon at 120. So dollar for dollar, you're obligated to put up more and more and more money. So you definitely want to pay attention to this. Again, as you can see, not only we're teaching you how to set up these strategies, but we're also telling you the reasoning behind it. And we're going to the interactive broker platform and showcasing you what to look for and where to look for it. So I think this is really valuable. By the end of this class, you're going to have multiple questions testing your knowledge on when to use calls, when to use puts, when to sell calls, and when to sell puts. So now the question that comes into mind is what expiry and strike to use. So I am bearish on Amazon, but what option expiry should I use? What strike price should I use? So your expiry depends on your time frame and thesis. If it's a weekly swing trade, you probably want to use the closest expiry, or maybe the next week expiry. If it's a day trade, or you think this trade will happen over the next few days, you want to use the weekly option, the earliest expiry. If it's a long-term trade, maybe months or even years, of course you want to go further and further away in the expiry cycle. I'll show you more example as we go back into our trading platform. What about a strike? If you're selling premium, try to sell at key levels. So if you remember and recall, when we were talking about Amazon, I said if I want to sell some premium, I probably use this as a level, or maybe use this as a level of areas where I want to sell premium. Of course, the further you go, the lower premium you're going to collect, and the less of course, the further you go, the less premium you're going to collect, and the less juicy that premium is going to be. So it's not going to be worth your time to actually take that trade. You also want to sell premium when implied volatility is high. So every time implied volatility is high, you want to sell premium because you're shorting volatility. If you're buying premium, on the other hand, you want to buy slightly in the money. So I usually call these 60 to 75 delta. You want to buy slightly in the money calls. And you want to buy premium when implied volatility is low. So let's go ahead and go back to our option chain and see what we mean by that. So if you want to buy a put, you want to be buying slightly in the money. So in this case, these are kind of your key strikes, slightly in the money, these first few ones. So these are at the money. This 117 is at the money. You want to be slightly in the money. If you're buying call, you want to be slightly in the money. So you want to be probably somewhere around here if you want to buy calls. So this is where you want to be. I put ITM as in 8 in the money, ITM as in the money, slightly in the money, slightly in the money. That's where you want to be when you want to buy and pay for premium. There is a mathematical reason why we're doing it this way, but the scope of it is beyond this course. If you are interested to take our advanced class, we're going to talk about why you're actually staying slightly in the money rather than at the money or out of the money options. It has something to do with gamma and the way that the delta changes that makes it ideal with the slightly in the money contracts. But again, it's beyond the scope of this class. If you believe that this is a long-term play and Amazon over the next 2 years is going to go down, you simply on the upper left side of the option chain, you can pick your expiry, so you can go maybe to 2023 and pick an option there. Of course, option get more expensive as the further you go in time. If you think it's a weekly play and Amazon over the next few days is going to go lower, you can simply click on the earliest expiry, which in this case is in 4 days. So the time that you pick depends on your thesis, how far do you think this trade is going to be, and where you're picking is you always want to be, if you're buying premium, you want to be slightly in the money, and if you're selling premium, you want to sell at key levels. And lastly is implied volatility. Your platform will show you what the implied volatility of the stock is, and overall, as a key thing to remember, you want to sell premium when implied volatility is high, and you want to buy premium when implied volatility is low. So around these areas, you want to be the buyer of premium, and around these areas, you want to be seller of premium when the implied volatility has been elevated. If you use Interactive Broker, which by the way is our recommended brokerage firm for trading terminal, you can simply go to New Window, Advanced Option Tools, and simply walk to Volatility Lab. Click on that and click on the ticker that you want to trade. So let's say in this case we want to trade Apple. So AAPL, click on that, bring up the chart. Now you see the chart and simply look at the implied volatility. Let's make this a little bigger so we actually can see. So again, you want to be a premium seller in these areas when volatility has spiked, so over 40%, and you want to be premium buyers in these areas when volatility is lower. So if you're bullish, you want to sell puts here because volatility is elevated, or buy call here because volatility is lower. If you're bearish, you want to sell call here or buy puts here in this area when volatility is lower. So implied volatility also plays a big role in what strategy you should choose. We covered a lot in today's class, and today's class is one of the longer ones, but we covered the basics of being bullish versus being bearish, buying calls versus buying puts, selling calls versus selling puts. In the next class, we're going to talk about covered call strategy as well as cash secured puts. Next class is going to be very short because covered call strategy is basically selling calls and cash secured puts is basically selling puts. But we're going to talk about some key reasons on when you should do them and how to really manage your risk in those scenarios. After that, in the last class, we're going to talk about vertical spreads. And vertical spreads are really, really powerful strategies that every beginner should know, and it's your stepping stone into the advanced option trading course. Hi, welcome back to class 6, the last class out of the option trading for beginners series. In this class, we're going to talk all about the vertical spreads. So let's get started. What to expect? We're going to define what vertical spreads are and why they're called vertical spreads. We'll talk about the benefits of using spreads versus the ordinary buying calls or buying puts. We define what credit and debit spreads are, and I'll give you key things to know using debit spreads, as well as key things to know when using credit spreads. So I'll give you a very clear guideline on when to use credit spreads versus when to use debit spreads. So let's get started. First thing you want to know, and first thing you ask yourself is, why is it even called vertical spreads? Well, the reason for that is you're looking at the option chain vertically, and the strategies you're setting up are based on that vertical strategy and looking at the option chains vertically. That's why they're called vertical spreads. So let's go ahead to our option chain. Let's take Apple for example. Click simply on option chain. Again, this is your brokerage firm. This is a simulated brokerage firm by Interactive Broker. Click on option chain and you can kind of see the option chain, and the strategies that you're going to set up is looking at this option chain vertically. So that means looking at the option chain from top to bottom, from bottom to top, and coming up with the strategies. Usually it involves buying one option and selling another, buying one option and selling another, all vertically down the option chain. So this is why these are called vertical strategies. If you decide to take our advanced option trading course, we'll talk about diagonal spreads, and those are the spreads that rather than going vertically up and down, you're going diagonally into different time series and coming up with different strategies. Those get really complex and very interesting really fast. So rather than defining these vertical spreads into bullish and bearish strategies, I decided to break this down into debit versus credit. So what do we mean by a debit vertical spread? It means when the spread is done, at the end of the day, you're paying for that strategy and money is coming out of your pocket. On the other hand, the credit vertical spread is a strategy where when the trade is done, you're receiving money. So the cash is coming into your account after the strategy is done. So both of these, debit and credit, can be made in a bullish way as well as in a bearish way. But looking at it in terms of debit versus credit is a better way of looking at these strategies. So let's start with debit strategies. Whenever you pay for your option strategy, you're going long volatility. You're betting on a fast move. So here, whether it's a bullish or a bearish debit strategy, you're betting that the move is going to be very fast, either to the upside or to the downside. You're betting on a fast move. Overall, it is ideal for the time that volatility is low, and you estimate that volatility will slightly move higher. Why? Because you're going long volatility. So you want the implied volatility, if you remember, to be lower and then a slightly ticking up. This strategy, the debit strategy, has a capped profit, but also has defined losses. So you know exactly how much you're going to lose before going into a trade. Debit strategy, in compared to credit strategy, is usually a lower probability strategy, but offers a good or a better risk to reward in compared to its counterpart, credit spread. Now let's talk about credit spreads. Whenever you're doing credit spread, regardless of you doing a bullish strategy or a bearish strategy, you're going short volatility. So you're betting on a consolidation or a slower move. So let's say if you have a bearish strategy, you're betting that the stock is going to consolidate and maybe slightly go lower. You're not really betting on a speed. This is ideal for the time when volatility is high, but it is coming down, or at least you're estimating that it is coming down. Why is that? Because when you're receiving money, you're going short volatility. So you're betting that you want the volatility to be high because you want to sell when it's expensive, and you're estimating that it's going to go lower. This is very important. Your profit in a credit strategy is capped, but you also have defined losses, so you know exactly how much you're going to lose prior to going into the trade. These are high probability trades. However, they don't offer as good of a risk to reward as their counterpart of debit strategies. This will make a lot more sense once we take a look at more examples. So let's get started. Let's start with debit call spreads. This is a great ideal strategy when you're extremely bullish and you think the movement is going to be very fast. It's really good for when you have a predefined target. Let's say you think Apple is going to go from $140 to $160. The mechanic of the strategy is very simple. You buy a call and then you sell a call against it to reduce the cost. It offers a really good risk to reward. However, since you're betting on a direction, it is a little bit of a lower probability trade. Meaning the probability of making money in this trade might be a little smaller than any different strategy. So let's take a look at it with a real example. This is the chart of Apple in front of me in my screen. Apple had an earning, and the earning was really good. The stock gapped up a little bit. You think the stock is going to continue its momentum and move from $162 somewhere to $170 over the next 3 weeks. So your bet is $162 to $170. So this is the move that you're expecting, and you're expecting this move to be fast. Why? Because Apple just had a catalyst, which was the earning, and the earning was really good. So you think this move is going to continue, and it's going to be a fast move, similar to what we saw here. So how do we go ahead and set that up? You go ahead to your option chain and you buy the 160 call and you sell the 160.50 calls against it. What it does, it reduces the charge and reduces the price you would pay if you just wanted to buy the 160 call. And by doing that, it allows you to buy more contracts of it because you're not putting as much money up. The payout diagram looks something like this. For every dollar that Apple goes above 163, which is your break-even point, you're gonna make more money and more money and more money, dollar for dollar for dollar for dollar, all the way until the 167.50. That's where your profit gets capped, right around here. So your profit is getting capped here. You're making all the money if Apple goes up anywhere from 163. So in this case, if you're putting up about a $3,700 investment for 10 contract of this, potentially, if you're right, you can make up to 3,700. So somewhere around here, up to 3,700. So as you can see, the return and risk, the risk to return is about 1, which is a decent risk to reward. One thing to note, however, is take a look at this profit probability. It's 45%. So let's go ahead into option chain and actually show you how you can set this up in a brokerage account. Again, please note that this is a simulated account, but it's for educational purposes only. So you open up your option chain right around here. You go ahead, you pick the expiry that you want. Let's say you believe the stock's gonna go over the next few weeks, so you go to August. You go ahead and buy, so you click on the strategy builder. You go ahead and buy the 165 call, and you go ahead and sell the 170 call against it. Again, this is going to cost you about $186 per contract. Let's say you're doing 10 of these, so let's increase this number to 10. Click on the profile and you can kind of see your profile. Over here, now the risk to reward is almost 2. You're risking 1,600. So let me bring that up. You're risking 1,600 for a potential of making 3,200. Now note that the profit probability here is now only at 33%. So what basically this is telling you is there is a trade-off between risk to reward and the profit probability. The higher your risk to reward is, so take a look at it, right now it's 2, the lower the profit probability is going to be. Let's see if we can make it even better. If we go ahead and move this leg from 170 to maybe 177, you can see your risk to reward all of a sudden increased a lot. Now the return to risk is 4. So you're only putting up $2,000 and potentially you can make $10,000. But take a look at what's happening to profit probability. Now it came down to 31% from 40% earlier. So there is a little bit of a trade-off between profit probability and your risk to reward. Setting up this strategy is extremely simple. Again, as the name is called, it's a vertical spread. So you're looking at the option chain vertically. You're picking slightly in the money or right at the money call options, and you're selling some call options against it. Which strike price do you sell? Well, it depends on your target. Where do you want? There is a trade-off, right? The further you go, the higher your risk to reward, but the more expensive it's also going to get. the smaller you go, so like let's say you're expecting a move to 167.50, the cheaper the contract is going to be, and the higher the probability. Now it's 41%, but your risk to reward is going to be minimum, so now it's only at 1. So there is a little bit of a trade-off in this trade. Now let's move on to another strategy, and this one is debit put spread. So again, as you recall, we break these vertical spreads down into debit and credit. Debit put spread is when you're bearish. So let's take a look at Meta. Meta is the same story. Meta or Facebook, they just came off an earning. They didn't have a really good earning, and you believe their stock is going to continue to sell off and go even lower. So let's say your price target currently at 158 and your price target is 125 over the next 3 months. So you think over the next 3 months this stock is going to go to 125 and the move is going to be pretty fast. So we're going to set up a debit put spread. Again, you go ahead to an option chain. You search your name or the ticker. So in this case, it's Meta. You put in the Meta in your order entry, click enter, and you click on the option chain. As you can see, in terms of the technical, the stock is clearly in a downtrend, right? So the stock is clearly in a downtrend over the past little while. It's been going up, but now it's coming down. Currently trading at 158. So let me go ahead to daily here. And you can very clearly see that the stock has been on a downtrend, really clear downtrend, and every time it has tested this resistance, it actually has moved lower. So now you believe it's going to even continue to come lower. So let's go ahead and set up that strategy. Click on the option chain. You think it's a move that is going to happen in 3 months, so let's pick our expiry accordingly. So let's go to October expiry. Select the strategy builder over here. Click this call, click this puts, and then your price target is 125. So sell 125 against it, and ta-da! You see, for about $1,000 investment for one contract, you can potentially make 2,500. So the risk to reward is at about 2.30, and for every dollar that Facebook goes lower, you're making more and more money. So this is kind of your payout diagram. So if Facebook drops by 75%, you'll make $2,400 in this one trade. If it drops by 50%, you make the same amount of money. Why is that? Because your profit is getting capped. Again, take a look at this profit probability. You got about a 37% chance of making money here. If you reduce this from 125 to 110, what would happen? Your risk to reward will increase, but your profit probability will come down a little bit. Now it's only at 35%, whereas if you bring it a little higher, your risk to reward becomes lower, but your profit probability increases. So now all of a sudden your risk to reward is only at 2, but your profit probability is at 40. So it is a trade-off of how much money you're putting up, and there is a little bit of a science and a little bit of art into selecting the strike prices. My recommendation for these debit strategies is you want to be slightly in the money, whether it's a put or a call, and you want to sell maybe a 1 standard deviation away from your target. So in this case, take a look at the option chain, and these dark blue lines means 1 standard deviation away, and these are usually about 25 delta. So this means this is a very good area to sell against it. So you can kind of see the delta here is at about 15. You're selling against it, still 1 standard deviation away. This is the optimal place in terms of how much money you're putting in and your profit probability. So now let's switch to the other side. Let's talk about the credit strategies. Now, the credit strategies are the strategies, the spreads that rather than you putting up money, you're actually getting paid. So that's why they're called credit, because you're getting paid for them. Let's take a look at McDonald's. McDonald's had earnings. The earnings was pretty good and the stock went up, but it seems like now it has topped out. Now in this case, a credit call spread is also a bearish strategy. Overall, it's a bearish strategy, bearish to neutral strategy. So sometimes I call this even neutral. And the reason for that is McDonald's was really strong, but it seems like it's going to struggle. Now your bet is the stock will consolidate and maybe even head lower. This is your bet. So what you're going to do is you're going to sell some premium here and buy some premium here to cover. So let's go ahead to our option chain and see how that would look like. So bring up the McDonald's ticker, MCD. Again, you can clearly see the topping action over here right around this area. So you want to sell some premium. And this is, let's say this is a weekly trade and you think this is going to happen over the next week. You go ahead and sell some premium. So sell some calls here and just buy some call for protection right around here. So the profile here is quite different. Now the best case scenario here is if McDonald's closed anywhere under 265. Why? Because if McDonald's closed anywhere under 265, you get to keep all the premium that you collected. So in this case, for every contract that you're selling, you're receiving $117, and in the best case scenario, you're making 117 bucks. In the worst case scenario, if McDonald's actually rallies and move past your strike price and goes to, let's say, $300 or $350, you're gonna lose $383. So the risk to reward here is only about 0.3. So you might ask yourself, this doesn't seem very good. When we just looked at the debit strategies and the risk to rewards are minimum 1 or 2 or 3, this doesn't seem like a good return to risk profile. Well, usually the credit strategies are higher profit probability strategies. So yes, the return to risk is not as good, but you over here you got almost 70% of profit probability if the distribution of return stays the same. So there are higher profit probability strategies that are being used and you can use. Same trade-off goes on in the credit strategies. So if you go ahead and bring this a little higher, you increase the amount of money you make from 117 to 132, but you're reducing your return to risk and you're also reducing your profit probability. As you can see now, down only to 68%. So a credit call spread is selling a call and buying another call for protection. It's a bearish to neutral strategy, and it's ideal for a time where implied volatility is high and you estimate that implied volatility is going to come lower. So it's a play on shorting volatility or shorting the movement of a stock. Again, as you can see here, this is how the diagram would look like. So now let's go ahead and take a look at credit put spreads. Now these are a bullish to neutral strategy. So in compared to credit call spread, credit put spreads are bullish to neutral strategies. So let's take a look at Goldman Sachs. Goldman also had earning. The earning was okay. Stock gapped up slightly and then had really strong days, and it seems like it is consolidating here to potentially make a move higher. This is what the chart is telling you. This is what the fundamental data is telling you as well. Stock gapped up, rallied about 10% after earning. So this shows that the stock is very strong. As a trader, you're looking at this chart and it seems like this area right after this massive candlestick is an area of support that will not break. So basically what you're betting as a trader is that the Goldman will not come below this 330 level, this around 320 level. So that's kind of your bet, that Goldman will stay above 320 because there is an area of support or there is massive buyers that will jump in and protect this price level. So one of the things you could do is you sell premium here. So sell some puts and then buy some put to hedge or cover against it. So let's take a look at, let's go back to our option chain and see how that would look like. We are in our trading platform, TWS Traders Workstation by Interactive Broker. Simply click Goldman Sachs. Again, very strong days, and it seems like, let me grab the crosshair here. It seems like this area right here, about 317, 318, This is the area of support. This is where the buyers will jump in. So you go ahead to your option chain, click on your option chain. You think this is a couple of weeks play, so you go 2 weeks out. Now you're looking at the option chain vertically. You're selling the 325 put, and in order to protect yourself, you're going to buy at 317, or let's say 315. Move this a little to this side. Yeah, there you go. So you got 322.50. This is the put you're selling, and you're buying a 315 call over here to protect yourself. Now your max loss in any case of a spread is the width of that spread. So in this case, this is about $7.50 spread. So that means your max loss in worst case scenario is $750. So let's go ahead to your profile. As you can see, this is a bullish strategy. So if Goldman continues to go up or stay above this 321 level, you're gonna get to keep all the premium you collected, which is the $85 you collected. Very high profit probability, almost 80% over here. And in case of worst case scenario, max loss is the width of that spread right around $750. So in this case, it's telling you that your max loss is $665. So that's how much you would lose in this spread. So let's recap. We have, in terms of vertical spreads, you could do them debit or credit, or you can look at them bullish or bearish. If you want to look at bullish spreads, you have debit call spread. When do you use debit call spreads? When you're betting on the speed, when you think the move is going to be very fast and it's going to be a vicious move. You could also use credit put spread, like the Goldman Sachs story that we talked about, example that we looked at. If you're looking at credit put spread, what are you doing? You actually believe that there's going to be some consolidation and the move is not going to be as fast. So you think there's going to be some movement and then maybe a slightly grinding higher. Remember, when you're doing a credit put spread, you're shorting volatility, you're going short Vega. And when you're using a debit call spread, you're going long Vega. So whenever you go long Vega, what do you need? You need speed. Hopefully you remember this from class 3. Whenever you're going short Vega, what do you need? You need decay. Right? So decay is the name of the game. You need slow movement. On the bearish side, it's the same story. You could have two strategies. You could do debit put spread, so buying a put and then selling a put against it. You're going long Vega here again. So what do you need? A fast move down. Or you could do a credit call spread, so sell a call and then buy a call against it. You're going short Vega, and what you're betting is consolidation and then maybe a slight move lower. The name of the game here is decay. You're betting on the option decaying. So this is the slide from earlier in the class, and I want to put it down here. If you could print this slide, this is the most important slide when it comes to spreads. Look at it in two ways. Debit strategies, you're paying for it. Credit strategies, you're getting paid for them. If you're going debit, you're going long volatility. Credit, you're short volatility. If you're going debit, you're betting on a fast move. And if you're going credit, you're betting on a slow move, basically betting on decay. I'll put it over here. Credit is ideal for when volatility is high, but it is about to come down. Debit is ideal for when volatility is low and you estimate that it will move slightly higher. Both of these strategies are capped profit and defined losses. Debit strategies are usually lower probability, whereas credit strategies are usually higher probability. And your max loss is based on the width of the spreads that you're doing. If it's a $5 width spread, that means your max loss is $500. If it's a $6 with a spread, that means your max loss per contract is $600. So very easy to calculate, very easy to set up. These are the foundation of our next course, which is the advanced option trading course. And hopefully we'll see you in our next course, which is advanced option trading for beginners. Make sure that you're trading in a simulator first and get your hands dirty with different strategy in a simulator before risking your hard-earned money. Thank you, and we'll see you in the next course.